Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are undertaking an extensive analysis of a company that is uh, really right in the crosshairs of market sentiment. Voyager Technologies, Inc., trading as VOYG.
It really is. I mean, this is a business platform that promises to, revolutionize both defense and the commercial space sectors.
That is the narrative, isn't it?
It is. Voyager successfully completed its IPO back in June of 2025, and it positioned itself as this high-growth disruptor.
But the sources we have, and we're looking at the Q3 2025 10Q filing, the earnings call transcript, and then all the market events through November, they paint a really complicated picture.
Complicated is a good word. You've got this tremendous strategic activity on one hand, combined with what looks like immediate financial deceleration on the other.
Absolutely. And our objective today is to really dissect that tension. I mean, you have a company that successfully deleveraged its balance sheet. It's embarked on a massive M&A spree.
Right. They've basically capitalized themselves for the next decade.
Exactly. But then you look at the core Q3 numbers, and you see a company that it suddenly stopped growing its top line while it was aggressively bleeding cash from operations.
So the mission here is to figure out if this is just a temporary investment hiccup or if it's pointing to some kind of structural flaw.
Precisely.
So let's look at that initial snapshot that defined the market reaction, because these numbers on their face are pretty jarring for a growth stock.
They are. Net sales for Q3 2025 were, virtually flat. We're talking $39,587,000.
And when you compare that to Q3 of 2024,
You're talking about a negative change of just $12,000. It rounds out to 0% year-over-year revenue growth.
zero. For a company that just went public. And what compounded that problem on the top line?
It was the expense side. The loss from operations didn't just expand, it nearly doubled.
Doubled from what, around 12 million?
It spiked from a loss of $12,093,000 in Q3 2024 to a staggering loss of $24,043,000 in Q3 2025.
So, to summarize that core tension, a recently public, high-flying defense innovator hits the brakes on revenue and accelerates its operational losses.
That's the fundamental conflict we need to spend our time unpacking because, management insists this was a successful quarter.
Right. Let's see if we agree.
Let's delve into the revenue trend first, because while that 0% quarterly growth is the headline, you really need to look at the broader trajectory to understand the context management provided.
That's fair. If we zoom out and look at the 9-month year-to-date performance, the picture does soften, considerably.
It does. YTD net sales reached $119,768,000.
Which reflects a growth rate of what, 12.5%?
12.5% growth compared to the $106 million reported YTD 2024. So the growth isn't gone, it's just uneven.
And this lumpiness is VOYG's central defense of their Q3 performance, isn't it?
It is. The management team stated that the flat Q3 revenue was entirely attributable to the planned wind down of specific legacy contracts.
Primarily that big NASA services contract within the Space Solutions segment.
Exactly. And they didn't just stop there. They actually provided an adjusted figure that was designed to capture what they see as the core growth story.
Right. They argued, pretty forcefully I remember, that if you exclude that legacy NASA contract, their year-over-year Q3 revenue was actually up.
Up a healthy 15%.
15%.
Which means the new business, the modern defense and national security work, is, according to them, growing robustly.
But the structural shift away from older contracts temporarily masked it.
Right. So for investors, this requires a leap of faith. You have to believe that the legacy contracts are truly just rolling off and not, being replaced by new profitable work in that same segment.
And that brings us right back to the losses, because even if you buy that 15% adjusted growth narrative, you still have to confront the cost structure.
You do. The loss from operations widened by an almost unbelievable 98.8%. It doubled to that negative $24 million figure in Q3.
That kind of margin deterioration signals a really fundamental shift in how the company is deploying its capital.
It does. And the adjusted EBITDA figure, which strips out things like interest, taxes, and so on, it deteriorated proportionally.
So it went from a loss of about $8.8 million last year
to a significantly larger loss of $17,693,000 in Q3 2025.
Wow.
This tells you that the expenses related to running the core business salaries, R&D, admin costs are just surging. and the revenue base can't support it right now.
It's a textbook case of investing aggressively ahead of the current revenue curve.
Exactly.
Okay, here is the metric that I think confuses many listeners, and we need to dedicate some time to explaining it. The basic net loss per common share actually improved.
Dramatically, yes.
It moved from a deeply negative $1.61 in Q3 2024 to a much better-looking negative 28 cents in Q3 2025.
Right.
So how can a company double its absolute dollar loss and yet report a significantly better per-share loss?
This is one of the most important takeaways from this 10Q filing for any shareholder to understand. That improvement in the per-share loss.
Yeah.
It's purely an accounting effect. It's a mechanical driver.
And it's a result of the dilution caused by the IPO in June.
That's exactly. Can I explain that mechanism?
Please do.
So before the IPO, the weighted average shares outstanding were small. Just about 12.7 million shares in Q3 2024.
Okay.
So every dollar of loss was concentrated among those relatively few shares. But the IPO, well, it dramatically increased the share count. That's what public companies do to raise capital.
Right. And in Q3 2025, that count exploded to what?
To 58,407,000 shares outstanding.
So they more than quadrupled the share count.
More than fourfold, yes. So you are taking a large and worsening net loss, the absolute dollar amount, and you're spreading it across a much, much larger pool of shares.
It acts as a divisor.
It's just math. It mathematically reduces the net loss per share, even though the company is fundamentally losing far more money operationally.
So if you're an investor and you're only focused on that EPS number, you are completely missing the worsening operational efficiency.
Completely. It's a vital lesson in looking at the entire income statement, not just that one single headline metric.
That really changes the equity story. Does management believe that the current market valuation justifies swallowing that much short-term dilution to finance their long-term vision? Because shareholders are definitely bearing that cost right now.
They are. And management's thesis is clearly that this dilution is necessary to achieve two critical outcomes. First, clean up the balance sheet, and second, finance the strategic M&A and StarLab development, which they believe will deliver disproportionate returns years down the road.
And this leads us perfectly into the success story of the quarter, which was the balance sheet cleanup.
It was. The IPO proceeds delivered immediately on that promise to deleverage. We see this dramatic reduction in net finance and interest expense.
That plummeted, didn't it?
From nearly $3 million in Q3 2024 to a near zero $200,000 in Q3 2025. That is a tangible, real financial benefit.
It's a phenomenal transformation of their capital structure. They essentially just hit reset on their debt profile.
They did. They extinguished the primary term loan, which involved repaying about $64.4 million right at the end of Q2.
And they also converted the convertible notes and the SMI promissory notes.
All converted into Class A common stock. So as of September 30, they are essentially debt-free.
We do have to acknowledge the cost of that transition, though. Getting rid of that debt wasn't free from an accounting perspective.
That's true.
The 9 months ending in September included a significant non-cash loss on debt extinguishment, totaling almost $8 million. What exactly is that charge?
Think of it as the accounting penalty for retiring the debt early. Often when you pay off a loan ahead of schedule, you have to account for unamortized fees or premiums. It's a non-cash charge, so it hits the net loss but doesn't affect the company's liquidity, which is key.
Just a one-time accounting cleanup to prepare the books for a zero debt status.
Exactly.
And the immediate upside, beyond the interest savings, is their newfound ability to generate significant investment income on the huge cash balance they are now sitting on.
Precisely. Holding over $400 million in cash post-IPO allows them to earn interest, especially in the current rate environment.
And we see this reflected in the big increase in other income, net,
which spiked to over $4 million in Q3 2025 compared to just $462,000 last year. That is a direct benefit of the IPO cash sitting on the balance sheet working for them.
So the IPO accomplished its capital structure mission flawlessly. The question is, what is the cost to the income statement?
Now we dissect the revenue by segment to understand the underlying causes of that overall flatline. This is where you see the difference between management's narrative and the actual reported numbers.
Let's start with the Defense and National Security segment, or DNNS. This is supposed to be the engine of growth.
And DNNS did, in fact, live up to that promise, at least on the top line. Net sales grew a substantial 30.9% year over year.
Reaching over $28 million.
Right. And crucially, this segment is rapidly dominating the business mix. It now represents almost 71% of total net sales.
That's up sharply from about 52% last year. So this confirms VOYG's strategic pivot toward that high-value, deep integration defense work.
And that growth was almost exclusively thanks to the U.S. government. The sources highlight a $12.9 million increase in U.S. government revenue within DNSS.
Which validates the thesis that VOYG is winning major contracts, particularly those related to missile defense and the Next Generation Interceptor, or NGI, programs.
However, that government strength was partially offset by some weakness in the commercial sector within DNS.
A $6.1 million decrease in commercial sales.
Right, which management simply attributed to program completion. This highlights an important risk. As VOYG focuses resources on these complex government programs, their commercial pipeline might be getting neglected.
Okay, here's the point that truly demands debate. The margin profile of DNS. Despite that robust 31% revenue increase, the segment's adjusted EBITDA shifted dramatically.
It did. From a profit of $876,000, a 4% margin in Q3 2024,
to a loss of almost $2 million. A negative 6.9% margin.
That is a negative swing of almost $3 million on a segment that is supposedly accelerating. So why would growth turn so dramatically unprofitable?
That is the central operational question, isn't it?
It is, and management's public explanation is that this is intentional investment ahead of growth. They cited two main culprits.
Okay.
Increased R&D investment within the DNS segment to rapidly mature proprietary tech, and critically aggressive talent acquisition costs.
So hiring high-end engineers, subject matter experts, program managers, all needed to execute the ramp-up of NGI.
That's the classic growth stock defense.
It is, but given that 31% revenue growth immediately shifted into a negative margin, how concerned should you be that this intentional investment is actually covering up execution inefficiencies?
It's a huge risk. If the R&D they're spending now generates a competitive edge that translates into massive profitable contracts in 2026, then the strategy pays off.
But if they are overspending on talent and materials for existing, often fixed-price contracts, which we'll get to, then that negative margin is permanent.
It reflects execution risk, not temporary investment. For now, we have to take management's word for it, but the clock is ticking for that margin to flip back positive.
And while DNS was aggressively spending, the Space Solutions, or SS segment, was aggressively contracting. That explains the overall flat revenue.
Indeed. Space Solutions net sales fell sharply by 40.9%.
Contracting to just under $12 million from almost $20 million in Q3 2024, this segment is bearing the brunt of those legacy portfolio changes.
And the sources confirm the primary reason was an $8.4 million decrease in U.S. government revenue, directly tied to the phase-down of those legacy NASA contracts.
This illustrates what they call the inherently lumpy nature of segment awards in the space sector.
It does. When you rely heavily on large government contracts, their scheduled completion creates these deep valleys in revenue that have to be filled by new awards, or they create this drag.
And just like DNS, the contraction here also hammered profitability.
Absolutely. The Space Solutions segment's adjusted EBITDA turned negative, registering a loss of $626,000.
A negative 5.4% margin.
Compared to a profit of over $1.6 million last year.
Yeah.
So in Q3 2025, VOYG had both its accelerating segment and its contracting segment reporting negative margins.
And that combination is responsible for that massive consolidated operating loss.
Then we have the StarLab Space Station segment, SSS, which is less a business segment and more just a massive ongoing project.
Right. It generates zero revenue but consumes significant capital.
Correct. Sales remain stubbornly at zero for StarLab. Its only contribution to the P&L is cost. And the adjusted EBITDA loss for StarLab widens substantially.
From about negative $4 million last year to negative $6.15 million in Q3 2025.
That's an increase of about $2.1 million in operational loss just for StarLab development in one single quarter.
Let's break down the drivers of that increase.
It's a combination of accelerating spend and diminished offsets. First, they reported $5 million in higher operating and R&D expenses as they accelerate toward the critical design review.
Okay.
Second, and this is a key accounting detail, they utilize $1.3 million less in grant funding as a contra expense compared to the prior year.
So less offset funding combined with higher spending means a wider reported loss.
Exactly. It seems VOYG is running two separate companies. A slow and steady defense contractor, and a multi-billion-dollar startup building a space station.
And the combined financial effect of these segment shifts clearly shows VOYG moving away from legacy commercial work.
The contract mix is unambiguous. Commercial and international sales plummeted from almost $8 million last year to just $3.5 million.
And conversely, reliance on U.S. government revenue, which includes both DNNS and SS, increased.
From about $31.6 million to $36 million. This means VOYG's long-term fate is now deeply, deeply intertwined with the U.S. government's budget priorities.
We've established that the loss from operations nearly doubled. Now we need to drill into the specific cost categories that drove that massive increase.
Well, we saw an increase in the cost of sales, which rose 10.6% to about $33.5 million. This is somewhat expected given the 31% growth in DNS revenue.
Sure, ramping up complex defense programs requires immediate spending.
Exactly, before the revenue recognition cycle fully catches up.
But the truly staggering figure is the selling, general, and administrative expense, SG&A. It absolutely exploded.
It did. It increased by 65.5% to hit $25,106,000 for the quarter.
65% growth in overhead is a serious problem for a company that's trying to demonstrate operational efficiency. What fueled this?
The sources break this Q3 SG&A explosion into two primary components. First, a $5.2 million increase related to employee compensation, tied to that aggressive talent acquisition campaign we talked about.
Right, the intentional investment in DNS.
Exactly. And the second component is a $4.5 million increase in administrative, marketing, and legal costs. This is the corporate scaffolding of a public company, auditing fees, investor relations, new compliance costs.
And if we look at the year-to-date SG&A context, the growth is even more staggering.
The YTD SG&A increase was $37.6 million total. And that figure is a clear manifestation of the IPO. It was heavily fueled by a couple of specific large items.
Looks like what?
$12.7 million in non-cash stock compensation costs related specifically to the IPO, and another $18.7 million in increased employee expenses, salaries, and fundraising commissions.
So it signals an extremely expensive one-time transition into public company status, plus sustained higher overhead going forward.
That's right.
Moving on, that massive operating loss also brings us face-to-face with a hidden risk in government contracting. The EAC, or Estimate at Completion Adjustments. This speaks directly to the margin integrity of their existing programs.
This is so critical for assessing execution risk. For Q3 2025, the company reported an unfavorable net EAC adjustment of negative $4.272 million.
Which means that VOYG's original best guess at the total cost to finish existing programs was wrong by over $4 million this quarter.
And they had to immediately book that loss.
That's a significant program performance hit. Where did the bulk of that come from?
The sources pinpoint the largest source as EAC growth on a significant program, leading to an increase of about $2.7 million. This was primarily related to cost growth associated with new program requirements.
So scope creep or unexpected technical hurdles.
Exactly.
Yeah.
And it matters so much for VOYG because of their contract mix. They noted that their reliance on firm fixed price or FFP contracts remains significant, totaling over $18 million this quarter.
And an FFP contract is a double-edged sword. Right?
Absolutely.
Yeah.
If VOYG executes efficiently and beats its cost estimate, the difference is pure profit. But if they miss their estimates, as demonstrated by that $2.7 million hit, the entire cost overrun is borne by the company.
It flows directly through the income statement,
lowering gross margin and increasing the execution risk profile. This negative EAC adjustment is the realization of that structural FFP risk.
Let's pivot to the forward-looking spend, which management uses to justify all this current cost pressure, innovation spend.
Right. VOYG defines this broadly. It includes traditional R&D and expenditures on designated development programs. Gross R&D was $3.5 million in Q3, which is a fairly moderate number.
But the total innovation spend for the quarter was a colossal $49.357 million.
It was.
When measured against net sales of about $39.5 million, that means total innovation spend represented 124.7% of Q3 net sales. That headline number is huge.
It is pure marketing, but there's a kernel of truth in there.
Yeah.
The vast majority of that spend, however, is StarLab capital expenditure. You have to separate the core business from the space station development.
So if we strip out the StarLab costs, what does the innovation spend look like for the core DNNS and Space Solutions segments?
Innovation spend, excluding StarLab, was about $7.5 million, which translates to a much more digestible 18.9% of net sales.
And that's the number management wants you to focus on.
Exactly. It supports their narrative that VOYG is investing heavily in IP and R&D to differentiate itself from the traditional defense incumbents.
Finally, a quick note on external forces, specifically the tax environment. VOYG mentioned the signing of the One Big Beautiful Bill Act, or OBB Act, on July 4th.
Yes, the OBBB Act is a significant change in U.S. tax policy, allowing for immediate R&D expensing. This is generally a massive benefit for R&D-heavy companies.
But VOYG stated that the immediate impact on their reported Q3 earnings was none.
Right.
Why no immediate impact?
Because VOYG is losing money. They have a massive existing loss position, which requires them to maintain a large valuation allowance on their deferred tax assets. Essentially, they have so many losses built up that this legislative change is tax neutral for the moment.
We've established that the income statement is under severe duress due to this intentional investment. So now let's look at the financial position, which, thanks to the IPO, is rock solid.
Or what management calls a fortress balance sheet.
And that description is justified, isn't it?
I think so. As of September 30, 2025, VOYG was sitting on a mountain of cash. $413.3 million in cash and equivalents.
That's a huge jump from $56 million at the end of 2024.
And more importantly, they achieved that coveted status of zero debt. All major obligations were retired or converted into equity using the IPO proceeds.
They also retained considerable financial optionality, maintaining access to their revolving credit facility.
Correct. They still have access to the $200 million undrawn senior secured revolving credit facility. This means their total stated liquidity stands at an impressive $613 million.
However, this massive cash balance is being drained very quickly. We have to investigate the negative cash flow figures. YTD net cash used in operating activities was a staggering outflow of almost $46 million.
And free cash flow paints an even starker picture. YTD free cash flow was a substantial outflow of $100,676,000.
To put that simply, VOYG is burning about $100 million in cash over 9 months just to execute its strategy.
And the vast majority of that cash burn is StarLab. If you look at the capital expenditure detail, gross CapEx YTD was $96.5 million.
And the sources are clear on the allocation.
$92.4 million of that CapEx was dedicated to StarLab property, plant, and equipment.
So construction in progress on the commercial space station.
Right. And while this spending was partially offset by about $42 million in NASA grant funding, the sheer magnitude of the gross spend confirms that StarLab is the engine driving this negative cash flow.
Okay, so given that they had $413 million in cash and minimal debt, the market was utterly surprised by what happened right after Q3.
The unexpected announcement of a massive $435 million convertible bond issuance.
This move was highly puzzling. Why raise $435 million in debt when you have nearly $415 million in cash?
The bond itself is attractive, a low 0.75% coupon due in 2030, but the capital structure implications are enormous. The conversion price was set near $31 a share.
And that $31 conversion price is fascinating because if the stock were to trade back up to that level, this bond would lead to the immediate dilution of about 14 million shares.
That's roughly a quarter of their existing share base, right after they just completed an IPO that already diluted existing shareholders heavily.
So what's the logic here?
Well, management is essentially signaling that even $400 million in cash is not enough to execute their aggressive 5-year plan without risking a future capital crunch.
So the market is reading this as what? The IPO cash is for operations and small M&A, and this new debt is for the really big ticket items.
That's the deduction. The IPO cash is for the high operating cash burn, while this new, cheap, long-term convertible debt is specifically earmarked for 2 pools: the potentially multi-billion-dollar cost of StarLab and the next tranche of large strategic acquisitions like Exotera.
So they are accessing the cheapest available capital. I mean, a 0.75% coupon is incredibly low and locking it away for large defined capital deployment.
They're prioritizing capital preservation over avoiding immediate dilution risk. They are trading future dilution risks for immediate financial certainty.
Let's pivot to strategic execution, which management cited as the core success of Q3. The foundation of VOYG's growth is built on aggressive, accretive M&A.
And we need to detail the deals that are supposed to fix those operational margin problems. During Q3, they finalized 2 deals. First, the EMSI acquisition.
That was the Radar AI software company, right?
It was acquired for a total consideration of $32.7 million. This deal brought in over $21 million in recognized goodwill, and it's all focused on synthetic aperture radar exploitation using AI models. Very relevant for national security.
And the second one was OPC.
Right, the OPC acquisition focused on high-precision optics and fabrication, a smaller $9.5 million deal. These are strategic tuck-in acquisitions designed to vertically integrate critical technologies.
But the big news came immediately post-Q3 with the announcement of the Exotera acquisition, a significant $100 million deal.
Exotera is a market leader in electric propulsion systems, and this is a game changer for VOYG. The transaction value was a substantial $100 million.
$69 million cash, $11 million stock, and $20 million contingent on performance.
And management explicitly stated its strategic purpose: strengthening electric propulsion capabilities and enhancing U.S.-based manufacturing.
It's not just full acquisitions either. VOYG is also actively snatching up strategic investments in IP.
They are. They acquired Bridgecom optical comms technology, which is critical for space data links. They also made a minority investment in latent AI for edge AI and maintained a strategic investment in Helicity, a nuclear propulsion company.
So they're planting seeds for technologies that might only become relevant 5 to 10 years from now.
That's the long-term vision.
And management was highly confident that this M&A spree would immediately address the margin erosion we saw in Q3.
They stated unequivocally on the earnings call that both Exotera and Bridgecom are expected to be accretive to the gross profit margin and immediately EBITDA positive.
If that holds true, these acquisitions will provide a desperately needed profit floor to the consolidated entity in 2026.
It's the crucial counter-narrative to the Q3 loss figures.
Let's move to backlog, which is the visibility into future revenue. Despite the flat quarterly revenue, the backlog showed resilience and growth.
Yes. Total backlog was reported at $188.6 million, which represents a solid sequential 10% increase from Q2. This shows they are actively winning new business.
And the funded portion.
That stands at $88.2 million.
And the conversion rate indicates high confidence in realizing that funded revenue soon.
They do. They anticipate converting a high percentage, almost 43%, of that funded backlog into revenue during the rest of FY 2025. Management expects to exit the year with total backlog well in excess of $200 million.
That's the good news. Now for the risk analysis. Customer concentration.
This is a massive risk. The backlog is highly concentrated. The top 3 customers account for 62.6% of the funded backlog.
62% from just 3 customers.
And the top 10 account for an enormous 90.4%. And we have to remember that for reporting, all U.S. government entities are consolidated into one customer.
So VOYG's fate is almost entirely dependent on the priorities of the DoD and NASA.
It's the trade-off. High growth potential, but very high single customer risk.
Finally, let's detail the StarLab space station development, the most capital-intensive element of the VOYG platform.
StarLab is progressing steadily against the NASA milestones. To date, they have completed 27 milestones and have received $173.7 million of the $217.5 million available under the NASA grant.
And the immediate hurdle is the Critical Design Review, the CDR.
The CDR is scheduled for December 2025. Successful completion is paramount, as it unlocks the next phases of funding. Management expects the Phase 2 award RFP late this year or early 2026.
We also saw strong external investor validation right after the Q3 report, specifically that Janus Henderson Group's strategic investment.
That investment signals continued strong market confidence in the long-term vision, despite the current losses. Management confirmed they are actively raising a Series A for the StarLab joint venture.
And their projected revenue figures are astronomical.
They anticipate $4 billion in annual revenue and $1.5 billion in free cash flow post-2029 launch. It's speculative, but the premise is they're building a necessary replacement for the ISS.
And the timing remains critical. They're still targeting a 2029 launch date, which is strategically ahead of the ISS decommissioning in 2030.
It is. If they hit that timeline, VOYG secures a near monopoly on high-value, government-supported LEO research for a critical window. And that potential long-term reward is why investors are tolerating the short-term pain.
Let's consolidate the guidance for the remainder of fiscal year 2025. VOYG confirmed its full-year guidance for both revenue and profitability,
They did. They expect revenue to come in at the upper end of the $165 to $170 million range.
which would represent roughly 18% YoY growth for the full year.
But this is a crucial metric because hitting the top end of that range means Q4 revenue needs to hit nearly $50 million sequentially.
That's a substantial step up from the $39.6 million they just reported in Q3.
It is. It confirms VYG is betting on a very strong revenue acceleration in the final quarter.
And despite the announced M&A being projected as EBITDA positive, they reiterated the full-year loss guidance for adjusted EBITDA.
Right, expecting a loss between $60 and $63 million. This is the anchor point for the cost narrative. It implies that the Q4 adjusted EBITDA loss should improve sequentially, but it underscores that the heavy investment spend is the structural reality for 2025.
Let's discuss visibility on their core defense programs. NGI, the Next Generation Interceptor, is central to the DNNS growth story.
NGI revenue is performing as expected, up a massive 130% YTD. The immediate focus now shifts from design to ramping up low-rate and then high-rate production through 2026.
And Golden Dome is the new opportunity leveraging that NGI technology.
That's right. VOYG is actively competing across multiple mission threads for Golden Dome, especially regarding space-based interceptor awards. Their confidence is rooted in the idea that they already solved complex technical hurdles for NGI.
What risks did management acknowledge on the earnings call beyond the existing headwinds?
They were very specific about external government risks. They acknowledged that a prolonged government shutdown could negatively impact the timing of the StarLab Phase 2 RFP.
Delays there mean delays in funding and potential delays in the 2029 launch timeline.
Which introduces substantial risk. And regarding space solutions, they managed expectations, confirming that headwinds from that legacy contract wind-down will persist through the first half of 2026.
So at least 2 more quarters of margin pressure and revenue drag from that segment?
That's what they're committing to.
Let's evaluate the overall management tone. The CEO, Dylan Taylor, called Q3 a very successful quarter, reflecting continued strength. This highly enthusiastic commentary just contrasts so sharply with flat revenue and doubling the operational loss.
And this is the crux of their communication strategy. Management is anchoring the narrative not on GAAP results, but purely on strategic execution.
Retiring debt, securing the balance sheet, accelerating M&A, progressing StarLab.
Exactly. They're asking the market to judge them on their ability to deploy capital and gain strategic positioning, rather than immediate quarterly profitability. They are essentially saying, we are investing our massive IPO war chest exactly as planned, and the short-term P&L be damned.
But the market reaction, where the stock dropped significantly after the IPO, suggests many investors are struggling to align that optimistic narrative with the current financial reality.
They are skeptical about the time lag required for profitability to emerge. The key takeaway for you is that VOYG is executing a high-risk, high-reward strategy that demands massive upfront capital investment and complete faith in management's ability to deliver.
It's a dual mandate that creates immense short-term volatility.
Sure.
To synthesize our findings, Voyager Technologies successfully used its IPO to achieve robust liquidity and full debt elimination. This enabled immediate strategic M&A execution like that $100 million Exotera deal.
But this focus on future growth is translating into severe financial pressure now, evidenced by that Q3 adjusted EBITDA loss of $17.7 million and an innovation spend exceeding 124% of sales.
The company is aggressively restructuring its revenue base, sacrificing legacy space solutions profitability while driving DNNS growth that is, for now, unprofitable due to upfront talent and R&D costs.
And that $4.2 million EAC adjustment also signals tangible execution risk on their high-value, fixed-price contracts.
And the capital structure is evolving at lightning speed. VOYG went from zero debt on September 30th to that massive $435 million convertible note issuance shortly thereafter.
And this debt raise, simultaneous with the YTD free cash flow outflow of over $100 million, signals immense, immediate, and continuous capital needs necessary to fund that long-term, multi-billion-dollar StarLab vision.
This raises a critical, provocative question for you, the listener. This financial volatility, the massive debt raise, the high cash burn, the immediate margin erosion, is VOYG truly demonstrating the necessary calculated cost of building a projected, once-in-a-generation business platform?
Or does this complexity and cash drain reflect inherent structural challenges in consistently converting high-priority government development contracts into sustainable, profitable execution? The next 4 quarters will be crucial in answering whether VOYG can bridge the gap between their strategic narrative and their financial reality.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research. Mindful markets, measurable meaning.